Good afternoon and welcome to our new webinar series, Tedstrom Talks. This is the fifth in a series of webinars that we are producing to give our clients, business associates, friends, and family pertinent and important information regarding COVID-19 and other interesting and timely topics. You have all been muted as far as your video and your microphone, but we do have a Q&A icon at the bottom of your screen. So please feel free to use that throughout the presentation if you have questions. And at the end of the presentation, at the end of the conversation between Steve Bellotti and Peter Testrom, they can answer those questions for you. I would like to right now introduce you to Peter Testrom. He's the founder and chief advisor of Tedstrom Wealth Advisors. Peter has 35 plus years experience as a certified financial planner. He has been consistently recognized through awards and recognitions as one of the country's top financial advisors. So Peter, if you'd like, take it away.
Very good. Thank you, Barbie. And nice to see you all out there, or at least know that you're out there. We've got some good friends, family, business associates, clients all listening in to, I think, what's going to be one of our best webinars so far. As Barbie said, we're doing these in a series, so pay attention to your emails. There'll be others coming up, and I'll mention those later in our presentation. So without further ado, I'd like to introduce you to Steve Bellotti, founder and managing director at Blue Sky Capital, Sydney, Australia. Many of you know that I grew up in Sydney. I lived there for about 7 years, my high school years, so I have quite a fondness for my Aussie mates, and I want to thank Steve for getting up so early. The reason the meeting or this webinar was moved to 3 is because we wanted to have a little mercy on Steve so he could get his cup of coffee before starting his day. So it's 7 a.m. there, I believe, or right at 7 a.m., right, Steve? Right. Steve has worked in leadership roles in financial markets for over 30 years across all asset classes, including managing fixed income, including rates, credit and derivatives, foreign exchange, cash derivatives, equities, debt and equity capital markets, including both sales and trading at a managing director level for over 22 years. He has transformed and led large teams in many of his roles and has a reputation for building high-performing, motivated teams that deliver strong results. He has built a number of large, complex global markets operations for global banks, including Merrill Lynch, Dresdner Kleinwort in London, New York, Sydney, Hong Kong, and Singapore. Steve, it has been quite an interesting time. The overused word unprecedented comes to mind, and I feel like even the use of unprecedented is now unprecedented. Let's start with the current economic backdrop, which everyone would like to understand better. We don't really get why the market has gone as well as it has following the big decline with Corona out there and no real solution to opening up. So let's start there.
Thanks, Peter. Thanks for having me, and good afternoon, everybody from California, Colorado, wherever you're at. So a couple of things on the backdrop here. I think everybody goes back to the GFC, which the Americans refer to the Great Financial Crisis, and the rest of the world refers to as the Global Financial Crisis. And that was really created by and came from the banking sector, with the rating agencies, with the federal authorities, etc. Not all in cahoots, but not really watching what was going on. An example would be banks were leveraged 40 to 50 times. They were lending money on balance sheet and then passing it off to pension funds and insurance companies, and this created the subprime crisis. And that led to a financial shock, of which eventuated in people like Lehman Brothers and others going out of business. And this has taken 10 years to get out of. So we've had low rates, we've had decreasing bond yields, we've had an accommodative Fed, and we've had a pretty strong stock market since, up until the whammy of February and March of this year, and in particular March of 2020. So just when you think it's safe to get back in the water, and we've all been wondering as financial practitioners, what do we need to do for the Fed to start gently and surely raise rates back to a respectable level of what we call the old normal? with reasonable good employment prospects, and we were there. We were starting to do this. And then we had this exogenous or external shock, both from a demand point of view and a supply point of view. And unprecedented in that we've never seen a forced shutdown on a global basis. So this has really set the scene, based on the disease, based on COVID-19, set the scene for the hardest part of what we're going to talk about, Peter, which is how do we get out of this mess that we're in? And how do we, if you like, adjust our policies and use critical thinking going forward rather than the blunt instruments we've used so far, because we had to act very, very quickly. And we can talk about that a little bit more. And the last thing I'll say before I pass it back to you and we can get into some questions is I'm really about what's going on at the macro level and the very big picture. So some of the numbers, et cetera, I'll state are approximate numbers such as GDP numbers, et cetera, but just remember that it's all about the direction and where we go from here. And the good news is, I think the glass is half full, but we've got some wood to chop.
Excellent. Well, that is a big question for people, is that how do we get back to, whether it's a new normal or an old normal, how do we get back to work? How do we get back into the restaurants and the theaters and, you know, all the things we used to like to do? Where I've been in, you know, quarantine for now maybe 9 weeks, and there's a lot of stuff that I'm missing out on or feel like I'm missing out on. I'm sure most everyone out there is feeling the same way. So what do you see for this economy going forward, Steve?
Yeah, so let's just talk really briefly about the history of the disease itself. So there were a couple of ways to manage it. We don't have a vaccine, we don't have therapeutics yet to control it and to manage it. And we didn't know how bad it was at the beginning. So the response was pretty significant, even though it took the US a while to lock down. There are other countries that locked down quicker, arguably Taiwan, China, Singapore, Australia, New Zealand, etc. They're a little bit more fortunate in that Australia and New Zealand are off the beaten path. They're not of the big Atlantic routes that we have between the US and Europe. And I think in the US, there were a couple of, if you like, cultural issues. I think, first of all, in New York in particular, they saw it as a long way away. They didn't realize that living in intense, one on top of one another type places where it's relatively cold, that it could be a real hotspot for the disease. And we were sitting over here knowing from a market's point of view that the markets wouldn't bottom out until New York woke up. And when New York woke up, it's kind of sell the fact and buy the future news, which is then the US got serious and started doing things and getting in control. And you know, you can take the politicization out of it because I know it's become very political. But to answer your question about restaurants and movie theaters and sporting events, you have to really consider at the macro level, what are we going to do both on a economic front and on a public health front? And how do we balance that so that we don't kill completely the economy and we don't kill too many people? But the response so far has been pretty big for a global sort of death rate of something, you know, circa 330,000 people globally. And we're just saying off the air before we came on, that number will get a lot higher, obviously, as India, South Africa, Brazil's having a real problem now kick in. So the emerging markets are going to take that death toll up. And so to get back into the normal way of life, you've got probably three things occurring. First of all, the Fed has signaled very, very strongly, we will do whatever it takes. We will go to infinity and beyond to keep the economy ready to go again. But that will only occur if you can open up. And I know some states are opening up faster than others, but it will also only occur if people have confidence to go back to the game, so to speak, or go back to work, or go back to the restaurants. And that will occur with therapeutics and a vaccine. And I think there's been a lot of Indian giving, if I can use that word about vaccines, i.e. we're talking about things that are being created here in the next 12, 18 months that's never been done before. It's facts that it's a fact that it takes years, decades to create these things. So I think one of the things the government's got to do, particularly in the US, is start to ready the population for the fact that COVID hasn't gone away. It still exists. It will get better during the warmer months because above 77, it sort of dies down. And it may come back, but I think the US has got to understand, like we do here in Australia, that just by shying away from it and locking ourselves away doesn't mean the disease has gone away. It meant we flattened the curve. Another part to your question, though, is what was the American public asked to do? And it's pretty much the same rule book all around the world. Shut down, lock down, social distance, wash your hands, etc., etc. Give us a chance to get on top of this so it doesn't act like a tsunami over the public health system and create havoc in the hospitals. And then we'll get back to normal. But they never defined how and what was getting back to normal. And this is the hardest part. The economic question here of getting back to normal is the hardest part, because you've got this balance of public health versus the economy. And I think the narrative is now swinging towards the economy, and it needed to, because quite frankly, and again, this is an apolitical statement, the economy is all important for people's mental health and all the other things that we know about. So from my mind now, you are going to open back up. You are going to see what happens slowly and surely, but you do need to prepare the American public that there are going to be spikes and there are going to be issues along the way. But in the grand scheme of things, many, many millions of people died in the Spanish flu. Many millions of people die from other diseases around the world every year. And I think the response has been, over the top sledgehammer approach to something that could have been managed a lot more credibly. And I'll give you one example. We could have checked medical workers going into retirement homes, and we could have isolated more older people rather than everybody, for example. But we are where we are, the milk is spilled. So now we've got to rely upon the Treasury, the Fed, the government in terms of how they handle coming out of this so that you can get back to normal. But it's going to take a while. The markets, they are a predictor of the future. An interesting thing about markets that I should say is that because you can put your money where your mouth is in financial markets, they tend to predict a lot better than when people debate in committees or when people are having a health versus economic discussion at government level, because the money's on the line. And so that public market where all the money meets, whether it's the New York Stock Exchange or the Chicago futures markets, etc., they're generally a pretty good indicator. And the markets are telling you, we're going to come out of this and things are going to be okay. But there's going to be a number of issues left behind. And to answer your question specifically, I'm glad we're starting to see it opening up. We do have to manage that public health situation as best we can. But the markets are telling us, okay, this is going to be okay if we get going now. If we wait too long, then it could be a much bigger problem we've got.
Interesting. We have a few clients that through our process of helping them, what I've been calling turn lemons into lemonade, getting people to rebalance, take their losses if they have them for future gains, and do some opportunistic buying. We have a couple clients that have said, I don't trust this market. This market has gone up too far, too fast. We're going to get back to work. We're going to open too quickly. The contagion's going to spread, more aggressively than it has in the past. What do I tell people today around the markets and what's happening and why it might be a good time to be investing?
Well, there's been a couple of things, right? So when we first spoke about us doing this, the market was sort of in much more turmoil and was going down rather than going up. Now you've got a risk, I believe, of a melt up. And I think your advice in some of your other webinars, and I know that your advice over the last 30 plus years to your clients, is that you can't time these markets. They present opportunities. You certainly don't want to bail out at the bottom, and you don't want to really bail out at the top if you're playing for the long term. And investing is all about investing over many, many years and taking the highs and lows that go with that and making your plan, as you called it, and staying with your plan, unless the plan changes for whatever reason, whether you get older, whether it's just a younger person starting out that can take more risk, etc. In my mind, I've been advising my friends and family that I don't see why the financial markets would continue on the down path that they were. But I do understand the disconnect. I understand one thing that probably better than most. What the markets are doing is bringing into account what the Fed is doing and the Treasury. And for the first time ever, the Fed and Treasury are in cahoots. And what I mean by that is Mnuchin over there, who works in the administration and runs the Treasury, ex-Goldman Sachs, very clever guy. He created the alphabet soup of let's create a number of special vehicles that will be run by the Fed that will guarantee certain asset classes. And generally, the Fed by law can only buy government-backed and government-backed assets like treasuries and high-grade non-corporate government debt. And today, they can pretty much buy anything. They could walk over there to Colorado and buy you a house if they needed to through a special purpose vehicle. And this is unusual. And this was how serious they took this global pandemic and this meltdown from hell. So what I mean by that is, generally speaking, the Fed's handcuffed at this level, but now they can do anything. They demonstrated to the market at the junk bond level, which are the bonds that trade, they're very low credit bonds that are issued by high yield companies that can't get to the corporate high grade market. And it's a very big market. And they started buying some junk bonds, and they bought the spreads from 700, 800, 900 over treasuries back down to 500, 600, 400 and normalized it. So the stock market is reflecting one thing that we've all learned for the last 40 years, which is you do not fight the Fed. Even if the disease is out there, even if the economy is put on hold, the Fed is like another planet. That Fed's balance sheet that has grown from, during the GFC, from under $1 trillion to close to $8 trillion today is a wonderful thing, in that, yes, we might have some inflation, and yes, we might have some problems with some volatility, but they're using that as a shock absorber, as the lender of last resort. The state has kicked in here, and the state being the Fed and the Treasury. And normally the Fed doing one thing, the government, the Treasury doing something else. And all I mean by that balance sheet expanding, and you need to understand this, is that by these guys buying government bonds that have been issued by the Treasury, the promise is they'll pay them back, and they will. That the US is not going to default on its debt. But it's the Fed's balance sheet that's buying the bonds and creating the money that then goes into the private system. And I'll leave you one other thought on that. 70% of the creation of credit in the market is by banks, and 30% is by centrally the Federal Reserve. So by giving the money out into the system, the banks then have more money to lend, and that fights the contraction. So stock market here, based on Fed and what they're doing in Treasury, and economy down there based on, okay, find us some cures, find us some therapeutics, and get us back to work, and the schools, et cetera, and the life that you spoke about, that, you know, the Americans love and the world loves the Americans for.
Interesting, great. We've got a couple questions from our audience. Does the Aussie market follow suit with the US market, or are the Aussies connected more with Asia or other markets?
You know, Australia is an interesting place. It's much more conservative than the US in terms of, what am I going to say here? You know, land of the brave, home of the free. We're ex-convicts. We tend to follow rules a little better than you guys. We didn't have as significant a downturn in any of these crises, and we've only had 100 deaths. And we've basically gotten rid of this thing. But as soon as we open our shores up and people come, then COVID's going to exist. And we can't go forward without transacting with the rest of the world, et cetera, both through tourism. Tourism's the number two export for Australia, i.e. tourists come, spend money, and they create a lot of value. And number three, basically, is universities. And we can't take the students at the moment because of the lockdown. So it's affected us, but we're a lot more conservative. And it's a lot easier to manage a small economy with a few states than a much bigger economy, a 10x economy, with a lot more states. And you look at New Zealand and everybody says, well, New Zealand was more successful than Australia. That's true on an absolute basis, but they only have 3.5 million. Australia's 26 million people. But we've been in our summer, we're just ending our summer, so we haven't had the cold season yet. And per capita, Australia's done as well, if not better than New Zealand. But they're extreme. We locked down. We just said no more, nobody can do anything. And now we're starting to come out of hibernation, and the economy will come back. But yeah, it's bad, but it's not as bad as I think in some other places. And the emerging markets in particular, as we talked, Peter, offline, are going to struggle here, which also leads to a big discussion point in the US, which we can touch upon, which is negative rates. When you're ready, we can get into that. But I think so far we've talked about the economy and what the market's doing. And the stock market's a very interesting thing because it seems to defy gravity at this point. And I do remember in '08, it was defying gravity. And in that one, they were wrong and the credit guys were right. And what you've got to do here is watch what the Fed does. If this gets more serious, the Fed will do more. The bazookas will keep coming. You know, you've already got Pelosi and the guys over in Congress, they're talking about another $3 to $4 trillion. And I think this should be discussed as well. The American economy is the biggest one in the world. It has a $23.5 million debt, but $1 trillion debt, but it has a $22.5 trillion economy in a normal year. And so when it's borrowing this money at virtually 0 to 0.5% in the shorter durations and at 1% in the long bonds, it's borrowing it at 1/12 or 1/14 of the cost of 1981 when your economy was 6 trillion and interest rates were 14%. So the cost to service the debt is virtually nil. And the question will become, does the cost go negative where you pay the US Treasury to hold your money? And there's a chance of that because it does exist in Japan, it does exist in Germany and a few other European nations. And why I say it can happen there, even though Powell says it doesn't, is simply if the US dollar gets so strong during this crisis, because it's the go-to sovereign currency and country, then Trump will get his way and Powell will cut rates to 0, if not negative.
Interesting. Yeah, I've been fascinated by the politicization of this entire issue. That you know, not only are we talking about two parties that are dealing with who gets funded and how much, but from house to house, neighborhood to neighborhood, friend to friend, different people are saying we should be opening up and getting after it. And I want to go to a concert the day we have a concert. And there are others that I've heard that say, I'm not leaving my house until I know I'm safe. How do we deal with that? And how does that fit in with all of what you're talking about this morning or this afternoon here anyway?
Well, I think we've got to accept, and I'm not an epidemiologist, but you know, when we discussed this several weeks back, the power of numbers is extraordinary. The contagion effect of COVID-19 is extraordinary. The good news is it doesn't kill you unless you're older or you've got some form of disease, etc. I mean, of that 330,000 people that have died globally, you know, you could argue that maybe 5 or 10% are actually caused by COVID. The other 300,000 were going to happen. So the response has been massive, and the government and the state put the response on the people and the population, and the government and the state, if they're smart, will take that response and reverse it quite quickly. I think we've got to live with COVID, Peter, and I think if you're older and you're susceptible and you have diabetes or whatever, you've got to be super careful, particularly in the cold times and particularly when you're in big crowds. It may be that you just don't go to a massive sporting event anymore, but you can still go to a restaurant and socially distance. Or you can still go to a bar theoretically and socially distance. Generally, if you're an older person, though, you should be in bed by then, late at night. You don't want to be.
Does that include you and me?
That's me. That's me for sure.
So, Steve, what do you think of the big takeaways in a post-corona world?
Well, a couple of things, right? So, just doing this, and you having been doing these webinars, etc., it's obvious that tele everything is here to stay. Telepresence, telecommute, telemedicine, teledentistry, pretty much the health changes are going to be massive. So the things that will continue and have been sped up by this are things like Amazon and the advent of or the event of online shopping and the delivery and the sort of, you know, the hands-free delivery with drones coming, etc. You know, so it's strengthened the technology sector, and the technology sector, you know, we all said 20 years ago, technology is going to be wonderful, it's going to be really good, it's going to put everybody out of work. And the last time I looked, you know, the unemployment rate in the US prior to COVID was pretty damn strong. So technology plays a part in dampening inflation, in increasing productivity, and I think we can all say one way or another we've found ways of being more productive, whether we've done it from home and or the office. So having said that, and thinking about what might happen at the margin, one of the riskiest assets in the world today, and generally considered safe, is commercial real estate, core commercial real estate. Yes, they're going to have some problems, but there's going to be more people looking for commercial real estate as time goes on. And at the margin, we may have 20% people work more from home than we used to. And the economy is going to be just as productive. We've proven that. Some companies such as yours have not missed a beat. Other companies can't do what you've been doing, you know, because or a restaurant can't serve food without turning on the oven and having staff. But if nobody's coming, why do it? You know, so to me, I think the other thing you've got to watch is the politicization of the Fed. It's the first time the Fed and the Treasury have come together to fight something this strongly. We've seen fiscal response before and monetary, but this is taking monetary response deep into that other world of we can buy anything if we need to. And I think that they're very concerned, and they should be. So separating out the Fed from Treasury at the end of this is going to be difficult, whether Trump gets reelected or the Democrats get in, because politicians love to print money. And even in good times, they love to print money because it's the go-to, right? It's printing money is the monetization of debt. And if you hold debt as an investor over the long term and inflation comes back, your debt yield doesn't stay up with inflation, and the value of your debt goes down in value. And then when the government repays you at the end of holding that debt, they need less money to repay you, and it's the monetization and the deflating of that debt. So it's either that, or you put up income taxes, which is not palatable in a crisis, both financial or economic and health. But I do see at some point the pipe has got to be paid. So things are going to look different from a technology point of view, from a tele point of view. I believe that the Fed will manage to step back from the Treasury, and the Fed will manage to keep its independence. And it's done a very good job since the 1900s. And it is the lender of last resort. And we don't want to take that independence away from it. They just needed help with this because it's never been done before, where you've stopped the entire economy at the same time, and you've done it globally.
Amazing. I want to remind the audience that there's a Q&A button down below, and if you do have a question, feel free to type it out there, and I'll make sure that Steve gets it. One of the questions here, Steve, is related to college kids. I have two. I have a junior. He's finishing his junior year at Cal Poly in California. My daughter just finished her freshman year in Dallas or Fort Worth at TCU. She's going back to school. They have decided they're going to do classes in person, at least for now. He's not. He's got at least a semester of online classes. He's not too keen about that. What is this going to do to kids' decisions around going to college? Maybe it's just that. And then what does it do to the industry, the college industry, the upper education industry?
Yeah, and as I mentioned before, it's a big deal for Australia as well, because a lot of Asian kids come to Australia. Well, Americans do as well. A lot of Asians come down to Melbourne, Sydney, and Brisbane. And our son is actually going to New York to start in September if it opens. And so far, the NYU said they are, but we'll see. I think actually right now we're still in the grips. I think we've kind of gotten through the shock, but we're in the grips of, okay, what do we do now? And I think things will look very different by the end of the summer. I think normality have returned. People will start to get more confident. Some of the states that have been quite left about, you know, we're not opening anything, we're going to kill this COVID off completely, which is not possible. It's just not critically thought through what they're doing, in my opinion. I think by the time we get started again, people will have eased the restrictions and changed their minds. And if they haven't by, you know, the 1st of September, they will by the 1st of December, etc. So online is here for those kids for a part of the way, but not all of the way. And I think you've got to look at the evidence around the place. China, albeit, is going to be in a very touchy situation with the US for some time. And I believe China have shot themselves in the foot in the way they've handled this accident, is my opinion. It has shot themselves in the foot. But what I'm saying is there's empirical evidence of those people going back to school, of going back to work. They're 90% back in Wuhan. They're back in Hong Kong full time. They're back in Singapore next week. Australia is now 50, 60% back, and it will be 100% back within a few weeks in terms of work and school. In terms of bars and clubs and sporting events and international air travel, that will come last. But I don't see that going for 12 months either. So my opinion is we'll look back on this sometime next year or the year after, 21, 22. We'll have the economy going again. We'll have unemployment back down. Well, the stock market will be a lot higher, and we can talk about the wealth gap a little bit if you like. The thing is, we'll have this all back, and people will say, what was that all about? Because when I first saw this, and I saw the Fed reacting and they cut rates by 1% on a Sunday, they don't do these things lightly. They knew they were going to do something along the lines of what they did as a policy response and close down. They knew, they were coordinated, because they didn't know how deadly COVID was. And it turns out it's not that deadly. It's deadly for the old and the sick. And, 75% of people that have died from this disease are above the age of 65 to 70, and 85% are above the age of 70. And they're generally carrying a medical condition of some sort. And you can't live forever. So I think we've got to look to the future. And I actually think that people will look back on this and say, what an overreaction that was. But at least we've had the dry run. At least we know what to do when something's that contagious, if it's a bigger killer than, say, COVID, amongst the general population. And the last point I would say is people have short memories. You know this. 08 happened and we all thought the world was ending, and Lehman that was it. AIG was next, Merrill was next, and so on. And then, the administration changed from Bush to Obama. We got going for a year or two, and the stock market, if I'm correct, has gone up 5, 6x since then, up until recently. And the stock market has handled itself fairly maturely, right? It sold off 30, 40%, didn't know what it was, started to look at it, starts to understand the dynamic, and they're telling you, they're betting the money on, this won't be a V-shaped economic recovery, it'll be a V-shaped market recovery, stock market recovery, with somewhat of a sort of a U in the economy. But I'm thinking the economy, first quarter of next year, will be steaming ahead.
Fantastic. One thing I don't know that I heard you mention is oil. Oil has been in the news quite a bit. I think it's hard for some people to understand how oil plays a role in our economy, other than we know the U.S. is now oil independent and energy independent, if you will. The prices are down. I spoke to a client today, and he said he wished he had bought a tank of gas when it was $1 US dollar per gallon. I said, you really saw it at $1 per gallon? He said he did. I remember years ago when we were worried about $4 a gallon. How do we look at oil today as it relates to the economy?
Yeah, so the whole oil thing's been really interesting, right? So I remember as a kid, this is dating me a little bit, we used to write assignments about OPEC in 1973 and 4, when the cartel was put together and what that would do. And, an interesting story for you around oil, because I obviously my family are American and from Colorado, and our kids were born there in Colorado. My wife grew up there, who's Barbie's sister, for those that don't know. And I've always been fascinated with oil, because oil is one of those things, and we touched upon this earlier as well, where it is the lubricant that made the economy work. And when the economy shut down, and I kid you not, my wife said to me, what do you think about oil? And I said, oil could go to zero. I never thought it could go negative, because I didn't think about the containment issue, where there was so much oil and not enough ships or tanks to hold it. And that was a futures contract in May that expired at, sort of went down to minus $30, $40. And even Warren Buffett, the mighty Buffett, was like, we've never seen this before. So the perfect storm happened to oil. They were having a spat between Russia and Saudi over what they call the new OPEC, between that lot in the Middle East and Russia. And Russia's also been trying to figure out how to crush the shale industry and the dependence, or the independence that the US has. So you got Russia and China always trying to figure out how to slow the US up so they can catch up. and you've got Saudi, who's the biggest oil producing nation and leader of OPEC, basically. And you've got oil priced in US dollars, and that goes back to the Nixon era when he took America off the gold standard. And Kissinger went over there in 1976 and said to the local king, we'll give you one thing if you give us two. And the two things the Americans wanted were, we want you to price oil in dollars and no other currency, because they recognized that they were moving off the gold standard. And if you move to an oil or a petrodollar standard and it was quoted in dollars, it would help you keep the sovereignty of your currency, which comes from World War II being the biggest creditor nation in the world to, by the way, the largest external debtor nation in the world today. When you have that sovereign currency, you can be a big, big borrower at very cheap rates. And there's nothing wrong with debt as long as it's well controlled and it's well managed. Debt can help fuel things, growth in economies, growth in companies. It's just not too much. And so when they did the deal, the other thing they wanted, the Americans wanted, you have to buy our US Treasury debt because with your spare dollars, because we've got a few issues over here coming off the gold standard and we need some help. And in return, we will protect Saudi from all and sundry from a military point of view, and we'll sell you the arms. And that exists still today. So here we are, and the world's sort of moving to, Teslas and batteries and, solar, wind, etc. And we're getting off this, if you like, the oil drug. And so oil's become more volatile rather than less. In the early 90s, I saw it below $12 and I'm like, that's interesting. And like your friend, we had the wherewithal to say we should be buying oil here because oil then traded back above $100. And generally, if there's a conflict, the one you've got to watch really for the US, in my view, is Iran, not because they're that bad people. It's just that it may be in their interest to start a little fight with the US, and that could spike oil again. But if you've seen oil in the last 3 weeks, if not even week, it's rallied tremendously because the economy is getting back on its feet. And $30 oil doesn't work for shale. You need $40, $45 oil. And the US will strategically subsidize that business and that industry. They've done it with airlines, they've done it with GM, they've done it with banks and insurance companies. They certainly will do it with the oil and gas industry to create that independence, which I should just mention, one of the big things I see down the track that is a risk factor from the printing of money and from oil and the economy rebounding is inflation. And inflation generally leads to the loss of value in debt instruments, high-grade corporates, government bonds, etc., particularly ones with long duration, say longer than 2-3 years, 5, 10, 30-year duration. And what that means is you're sitting there knowing that someone's going to pay you back, but the value of your debt security is going down during inflation. And we have not had any inflation for quite a period of time. And I think technology's dampened it down. I think low rates are here to stay for a long time. And there's the MMT crowd, which is the modern monetary theory, which says, look, you can print money, it doesn't cause inflation, so we can print till the cows come home. I think all rational people, what we call the pub test, say, well, you've got to pay it back at some point, unless you're going to do an Argentina and default on your debt. And the US is in good shape because its debt to GDP ratio is still one of the best in the world. It's just gone above 100%. So all that means is it's got 23.5 trillion of debt and it's got 22 trillion of production GDP every year. So theoretically, it can pay off its debt and back its sovereignty on its treasury debt that it's issued. So for me, oil is just another commodity. It moves a lot. It's going to be soaked up a little more than it has been. There are going to be competitors. There are lots of people working on lots of alternate energy solutions and better for the planet and the greener for the planet, etc. And user will pay. There'll be more user taxes for, carbon offsets and all this kind of thing. And I think that's a trend as well. That trend will continue, given the post-COVID world. I must say though, that the COVID thing's been bigger and wider. I think it will be shallower and faster to come out than the global financial crisis of 2008. And as a markets practitioner, we went very close to really going down the rabbit warren of a depression in 08-09. I don't think we're there. I think the Fed has done a very good job. The Treasury's done an extremely good job. I'll leave the politics to the Democrats and the Republicans, but I think Americans can be very happy with the way their central authorities have backed them up here, protected them, but Americans need them to show some leadership now and get back to work, albeit a little bit gingerly, both school and work. And I think you'll look at it next year and go, wow, that was quite the overreaction. We'll see.
Interesting. Well, I hope so. I have a question from Julie. As we are seeing a huge wave of people turning 60 plus, and as you say, the only, relatively speaking, are the folks who will die or get very sick. How do you reconcile the health issues and the economy with so many young people not being able to get jobs, burdened by huge debt, and with little savings, inability to form households as in the past? Doesn't this create another new normal for the world?
Yeah, so it's a great question. So I don't want to sound like, I don't value human life, but if you've got to make choices, and everything is a cost benefit analysis, everything. I mean, when we drive to work, you've got a greater chance over a period of time dying in a car accident than you do from COVID, even if you're 60. So we've got to put this in perspective, right? And again, I'm not a health expert and I'm not an epidemiologist, but I do watch trends in financial markets and how they're affected. And I think we've put the youth at risk, but justifiably so, for a lockdown and short blast. And if that doesn't work and we don't come up with some therapeutics and vaccine quickly, we're just going to have to accept at a societal level, at a global societal level, that it is socially acceptable for people, 95% of people that were going to die. They didn't die from COVID, they died from diabetes, heart attack, suicide, homicide, etc. And it's not meant to be a political statement. It's just an economist will tell you there's a cost benefit analysis to everything. So the cost to society has been massive. The central authorities have done a very good job at staving off as best they can, and they will do more, by the way, Peter. There's more stimulus coming. There's no doubt about it in my mind, because this is a deep, serious problem. And to the lady's question before, is that we owe it, the older generation, the boomers and beyond, owe it to the millennials, the Zs, the Ys, the Xs, and whatever it comes after, to give them and pass them on a strong economy, because the sound base of a good family, healthy and wealthy life is an economy. And at the heart of the economy is private enterprise and government. It is what it is. And so if we lost a few million people rather than a few 100,000 people, my view is I think that's socially acceptable, so that we don't put the debt and the burden and all of the problems that will come, depression and all of the other medical issues that will come for younger folks, if we don't get going. And it's incumbent upon us all to speak our voices to our, local members of parliament and politicians in the US, etc., and senators and congressmen and women, and say, look, okay, when we went into this, nobody really thought too much about the economics. They were all frightened of the disease. But we know what the disease does. And remember what we said, which was flatten the curve, don't let the hospitals get overrun. We've done that. And so now it's time to be really, and give it a lot of critical thought, and I've used those words a couple of times, because critical thinking will get you out of most problems. When you're stuck on an island and the planes are going by and you're waving, etc., you will figure a way to get attention to that plane if you want to live. And what I'm saying here is the planes can fly. Everything's ready to go. We just cannot continue to hide from the disease for much longer. Otherwise, all of those young people are going to have a hell of a time. And being able to work and being able to go to school rather than online, and being able to interact at sporting events and bars and all the things that people like to do is just good for our mental well-being. It makes you more productive. So it's incumbent upon everybody, including the governments, to show leadership here and get back at it.
Excellent. Amy says, you are the first person I have heard who says that the virus will be less prevalent when temps are over 77 degrees. Has that been the case in Australia? When did Australia first recognize that the disease was in the country? Kind of a twofold question there.
Yeah, no, we were lucky because we've had a wonderful warm weather pattern down here going into winter. I mean, it's literally been between 68 and 80 degrees pretty much every day up until the last couple of days. And it didn't come from Australia. They discovered that Florida didn't do as badly as, say, New York or Michigan. And there's two reasons for this. And again, not being a specialist. One is what I call the forced social distancing in Florida. You don't live on top of one another in Florida as much as you do in New York City or London. And number two, so there's less people per square meter. And number two, it's warmer. It's been proven by scientists that the particles that are passed from one person to another in humid, in particular humid and 77 and above temperatures, the particles don't jump as easily or as quickly across. The projectile of the particles don't get across. And again, don't quote me on this, but it's been shown that warmer weather will help. And therefore, you've got that to look forward to beside your own summer and the things you do in the summer. And it will give you time to get the economy going, but also think critically about, well, what is it that we need to do as we go back into the winter, come November.
Interesting. You helped me think as I was listening to you around statistics and how there's been a lot of debate and skepticism around the statistics. We turn on Fox News or CNN and we see, the millions of cases and the hundreds of thousands of deaths. And then we do our math, or the math is done for us, and it says, all right, the death rate is 7%, 6 or 7%, which seems awfully high. I've heard others say, no, the rate is really 0.7% because the number of tests are so low. And a lot of people are not necessarily dying from COVID, although it's listed on the death certificate. Tell us what you think about those statistics. How do we believe the statistics? What should we be looking at for truth?
Well, if we go back again, what my son asked me, who's getting ready to go off to college, he said, Dad, how bad can this be? And this is going back 10, 12 weeks. I said, well, if 1% of the world got killed by COVID, then 1% of 7.5 billion is 75 million. So there's your extreme statistic. And things have wiped out that many people before. We've seen the plague, we've seen the Spanish influenza, et cetera, wipe out 40, 50 million people. And on a much smaller base, by the way. And then the epidemiologists had all these models, and you needed time for actual empirical data to kick in versus the modeling. And when you look at it, basically, you take Australia, we have 26 million people, we have 100 deaths. So that's not even, 0.7%, it's way less. My point is, it's way under 1%. It's probably closer to somewhere between, when it's all said and done, the mortality rate is somewhere, around 0.05 to 0.1. And that's quite acceptable because something's going to get us all. We know that, right? The healthier you can be, and this is unfortunate about the inequality gap. I mean, clearly America's got some questions to answer. The social inequality, the healthcare system, the trillions that you face going forward to pay off, et cetera. Just the welfare question around that, the disease. If people could be healthier, then your hospitals may not have been threatened with the overrun, and so on. And they're very big questions, and much harder to answer questions for people like me than say where the stock market goes or what's happening with the US dollar in only a given week or month. So in my mind, again, I only go back to history, I go back to economic history, and I go back to what this has been. And I can't help but feel we're hiding from the invisible enemy that isn't that deadly. And I think almost in hindsight, I think if the world were asked a question again, and we applied a little bit more critical thinking to it, we probably would have had some different responses. For example, older people need to stay home for a bit here while we figure this out because you're the most at risk. And as we went through the crisis, we knew that. It became more reinforced. The scientists were correct on that. It also said that younger people, particularly kids, don't seem to pass it as much. So those guys can stay in school. Problem is, if your parents are living with you at home, you've got an issue. So then maybe those kids can't go to school if you want to keep your parents alive, or your grandparents alive for whatever reason, or your older parents. And so there could have been a bit more of a rifle shot approach rather than the scattergun approach to this. But it is what it is. We are where we are. But thankfully, it's just not that bad. I mean, America has, had a terrible time with it, but it's, in the grand scheme of things, it hasn't been that bad. And the public did a pretty good job at locking down to give the authorities a chance, and rightfully so. And this is what I admire about America, but it makes it interesting, which is you do revere your freedom. You are the most democratic nation of the world, and one of the most successful, if not the most successful. And that flew in the face of a central, controlled, military, rigid response like China. Yet you adopted the Chinese model, interestingly enough, of lockdown and do this and do that. And you watched the constitutional battles begin around states and cities and the federal government. So, thankfully in my mind, this is why I don't think I think the economy bounces back. I do feel for what I call the gig economy, the younger people, the people that would even need, waitressing and waiters and bar jobs, et cetera, to get by at college, et cetera. For those people to feel normal again and have a bright outlook, because just having a confident outlook is as good as having a job, because once you get confident, you'll go look for the job, you'll write your CV, you'll use your shoe leather to find a solution for you. And so that's what we need to do. And the economy, I know I come from a finance background, but the economy is so important to the well-being, to health and wealth. It's as simple as that.
Yeah, fantastic. One last question, and that is, and this is not meant to be a political question at all, but if we continue to recover as we see it, does that mean Trump gets reelected?
I thought for sure he would prior to COVID. And if you just remember, what were we doing prior to COVID? Stock market was going up. He is what he is, right? And he loves to talk about the stock market and how it's a sign and the health of the economy. And I don't think you can conflate the economy, the broader economy out in the Midwest, et cetera, with Wall Street. I just don't think that's right. But, let's just say President Trump likes to talk about the stock market. I was one of the few people that said during the crisis in the very early days, don't panic, you could see new highs in here. And new highs being, okay, that's what's going to get him re-elected in his mind. So whether he gets re-elected or not, he's sitting there every day in the Oval Office going, I'm going to get new highs. And I'm going to put pressure on Powell and everybody else to get those new highs. So now we're talking about not health, but we're talking about wealth and wealth creation. So there was nobody talking about new highs in the stock market 8 weeks ago. The NASDAQ has almost done it, if not it has done it. I haven't looked recently, but it's close. And, the rest of Wall Street's coming along. So if the trend continues, and remember, it's May. It feels like we've been in this thing, you said, for 9-10 weeks. It feels like we've been in it for 9 or 10 months, right? Or a couple of years.
Yes.
Because people just don't do well with having their freedom and their liberty taken away from them. But at least we're not at war, and people aren't flying over the top of us, dropping bombs, et cetera, like they were during the Blitzkrieg in World War II and this kind of thing. And what it brings me to is, I think they realize at the very heart, not just Trump, but the Democrats, the Congress, the Senate, the Fed, the Treasury, you've got some incredibly talented, bright people at the levers of this economy. And they've balanced it probably a little bit more with the health side than I would have thought they would have done. I would have thought I said to my wife, Trump will bring this thing back quicker than anybody else will in the world. And he is. The question about Australia, we're still sitting over here scared of our own shadow. We don't have COVID here, basically. And we haven't opened up. America's opening up, but America leads. It is that shining light. And whether you like him or you don't like him, whether you're a Democrat or a Republican, he's going for it I don't think just 100% selfish reasons. I think he realizes, along with all the other smart people, that you need a strong economy. And it doesn't matter whether you're a Democrat or a Republican, you're going to need that. Having said that, I don't know if Joe Biden's going to be the candidate come November, because he's got to get his act together from a, being able to sort of compete point of view. And I think he's getting a little bit out there and long the tooth, and it's affecting his performance. So it may be that you have Cuomo or someone else, I don't know. You're with Joe at the moment, but I also think the base of the Democrats, from what I read, is bigger than the Republicans. So if they can get the base out, they can win on the back of a shitty COVID performance and if Wall Street's not firing. So it's a really interesting one. It's a lot closer now. I think the stock market will perform stronger if he wins. And I think if the Democrats get in and they get a majority here and there, then look out, they'll get their hands on those levers and spend a lot of money. And it will be good short term, but it will lead to some of the risks that we referred to before. The one risk that we didn't talk about, which I find interesting in that oil question, is the economy they call going forward is what they call the onshoring. We used to offshore everything. You would send and export your jobs to China, India, Indonesia, wherever there was cheaper labor that could produce the part, like Apple and its phones. We'll produce them over there and then we'll bring them back and sell them here in America. And now they're saying we're not going to do that because we can't rely upon, for example, the pharmaceutical supply lines to China. We can't do that anymore because, they can just cut us off and we're stuck without antibiotics. So the onshoring that's going to go on in the US is going to be massive. And that tells me there'll be many more jobs created than you had before. And that tells me manufacturing and other things will come back. And if any economy in the world can go it alone for a while and sell to itself and trade with itself, it's the US economy, more so than any other economy. And so I think you're going to see onshoring and what we call the resilient economy, where people will get more jobs and people will get paid more. And you'll see what we haven't seen since the 70s and 80s, you'll see some wage push inflation. And there's brighter people than me in the US are calling for inflation to come at 3-4% within 2-3 years. If that happens, then you're back on your feet and you're booming, but the interest rates will have to go up. And when interest rates go back up, it slows everything down because you have to have higher mortgage payments, higher car payments, et cetera, et cetera. But at some point, to that normalized question, just having watched finance for 40 years and economies and all these shocks to the system. And Peter, I think you and I have seen everything sort of 87 onwards, right? I mean, we weren't around for the early 70s days, sort of dark days. But I think the issue here is you're in good hands with some of the people like Powell and Mnuchin, et cetera. Doesn't matter what their politics are. And, Trump's a known commodity. It's just the Democrats have got to sort out what they're going to be known for and what they're going to say to the American people. Either or, though, I've never believed that the president of the United States deeply affects the outcome of what the stock market or what the economy is going to do. There's too many other stakeholders and players that control that with them. So he can bluster and he can muster, but he's not the only guy in town, is my answer. So we'll see what happens.
Yeah, fascinating. I was thinking back on my career, 35 years. I started in the business in 84. And in 87, we had Black Monday, market dropped 22% in a day. And I think both of us, having had such experience over 30, 40 years in the markets, we really do understand that to bet against the US market is a bad bet. Somehow, some way, we figure it out. We're resilient. We spend money. We like stuff. We like to work. We like to make money. And it all leads to a lot of the optimism that you're talking about today. So thank you for a wonderful dose of optimism today. We get so much pessimism through the media. I wanted to have you on because you do present an idea that a lot of people, or a perspective that a lot of people don't get to hear. So Steve Bellotti, thank you so much for getting up early this morning. We really appreciate it. We might even have you come back in 6 to 12 months and see if some of these predictions actually came true and how you're thinking about the world at that point in time. Greg Moss is coming up on June 2nd, and many of you may know the name Greg Moss. He's Channel 9. He was a Channel 9 anchor for a long time. Great guy. He's become a good friend over the years. And he's now the innovation coordinator for the city of Westminster. And his title is Innovation, a Mindset and a Must. That's Tuesday, June 2nd at 2 p.m. And then another, I think, very interesting topic is with Dale Buckner. He's the Global Guardian CEO, and he's going to talk about global travel, the future of travel, what it's going to look like, how we're going to get on airplanes, how we're going to feel about going to other countries. So I think both of those are must-sees, and we hope to see you back then. And thank you all very much for attending. Have a great afternoon. Bye-bye.